Today's webinar will be presented by Lauren Fenner, Ashley Hershey, and Brian Marchuk, who are all audit principals within our nonprofit practice, as well as Seth Nolt, who is our IT director and has a background in nonprofit IT prior to him joining Brown Plus. As you can see on our agenda, our presenters will cover topics related to Form 990, strengthening internal controls, nonprofit budgets, and cybersecurity and data protection. Please note that we do have a 10-minute break scheduled about halfway through the webinar today. And now I'll pass things up to Ashley for our 990 and related topics.
Okay, thanks, Kayla. So today I'm going to talk about how to get your 990 to rank highly. I'm going to talk a little bit about compensation reporting as well as unrelated business income tax. So first thing I wanted to touch on is what is a 990. So this is your annual filing with the IRS for nonprofits, and there are 3 types of them. So 990N is often referred to as the postcard. And so if your average gross receipts for 3 years are below $50,000, you can file this type of form. And this form is very easy. Any nonprofit can do it themselves. And then there's the 990EZ, which is kind of in the middle. And then there's the full 990, which has several pages of questions, lots of schedules. It's pretty extensive. So that's what we're going to spend most of the time talking about today. So why does your 990 matter? So first of all, obviously, compliance with IRS requirements is very important to keep your organization in good standing with the IRS. But there are 2 other reasons. So donors and grantors will often use your 990 to determine if and how much they want to donate to you. But also it's about public and community trust. So the 990 information is publicly available. So it's important to keep that in mind. Talking a little bit about donor resources. So if you're a donor, what options do you have to research organizations? So for all tax exempt organizations, your 990 is open to public inspection, except for Schedule B, which includes donor names and addresses, but everything else included on your 990 is open to public inspection, and donors can get that either on the IRS's website. Another common source used to be called guidestar.org. Now it's candid.org, so you may hear that used interchangeably. That's a free, very easy to use resources that donors may be using. Another resource that donors may be using are the various websites that will rate charities. So a common one is Charity Navigator, and so they will only look at 501c3 organizations, but I'm going to spend today, some of the time today, talking about the different areas that Charity Navigator specifically will look at, though all of them have some variation of these items that they're reviewing. So there are 4 rating areas that they'll look at. So the first one is accountability and finance, and that's the one that we'll spend most of the time today talking about. This area, Charity Navigator is scoring your organization on these items, whether you ask them to or not. So it's important to be aware that this is happening, like I said, whether or not you ask them to. And it's very Googleable, if that's a word. So it's important to keep that front of mind if you're a nonprofit organization. There are 3 other areas that they'll look at. So impact and measurement, culture and community, as well as leadership and adaptability. And those 3 items are self-reporting. So if you don't contact them to list those items, they will not. So I'm going to delve a little bit more into accountability and finance, since that's the one that is happening regardless. So key accountability metrics that they'll look at. So they're going to look for that the majority of your board members are independent. So a common example of someone who's not independent is if your CEO is obviously compensated. Sometimes CEOs will have a vote on the board. So if that is your organization situation, that is an example of a board member that is not independent because they are an employee. They'll look at board size. So depending on the size of the organization, they want to see 3 to 5 independent board members. They'll look at the level of financial statements that you're getting. So there are 3 levels that an organization could get. You can get a compilation, which is the lowest level of service, a review, and then an audit, which is the most comprehensive financial statement that you could receive. So this area is weighted relatively heavily. And for organizations that are in the $500 to $1 million of revenue range, they're looking for any of the 3 financial statements to get points in this section. For organizations that are $1 million plus, they want to see an audit, and they want there to be an audit oversight committee. And there's a question on the forum about that. And they want to verify that there was no significant diversion of assets, aka fraud, and there is a question about that on the form as well. They're going to look at tax form disclosures and policies. So they want to see that you have a website. They want to see that you have these 3 policies. They want to see a conflict of interest policy, a whistleblower policy, and a document retention and destruction policy. And these 3 policies, you don't need to attach them or anything. You just need to confirm the existence of them. And then they want to see that you're documenting your board meeting minutes. And again, that's a checkbox. Okay, so we're at our first polling question. So it is which of the following is not an actual type of the Form 990? So option A is 990A, 990N, 990, or a 990 EZ. So we'll give you a couple seconds to answer that question. Okay, so close that. The answer is 990A. That is not one of the types of 990s. So continuing in accountability and finance, so they'll look at your website disclosures. So they want to see that your 990 is posted on the organization's website. So like I said, it's available several other sources, but they want to see it posted by the organization on their own website. They're going to look at some financial metrics. So first item is liabilities to assets ratio. And this is a single year analysis that they'll do. This is fairly heavily weighted. So higher leveraged organizations aren't going to fare as well for this item. And there's only so much you can do about that. But again, about awareness. They're obviously also going to look at your program expense ratio. So one of the pages of the 990 is the functional expense schedule, where they will have you list out all of your expenses and then functionalize it either as program, management in general, or fundraising. So they're going to look at your total program expenses as a percentage of your total expenses, and they want to see that be about in the 70% range. And this is a very heavily weighted area. And I want to be clear, I am not advocating for anyone to, just simply change their allocations to hit this benchmark. But it's more so about knowing that this is the industry benchmark, as well as, if you're out of sync with that, well, are your allocations appropriate? Or are there things that you need to, take another look at your spending and see, are there ways that you can get your management in general or fundraising expenses decreased and just be more efficient? So I want to be clear, that's the message I'm sending here. There are some metrics that they'll look at depending on revenue size. So for organizations with $2 million plus in revenue, they want to see that you're providing the 990 to the governing body before filing. They do not want to see any loans to or from related parties, and that would be employees, board members, those sorts of things. They don't want to see that. They're also going to look at working capital as well as fundraising efficiency, and fundraising efficiency as in total fundraising expenses compared to contribution revenue. For organizations that have $50 million and higher of revenue, they're going to look at some additional items. So they're going to go out to the organization's website and check some of these things. So they want to see a donor privacy policy posted to the organization's website. They want to see board members listed on the organization's website. They also want to see key staff members listed on the website. Lastly, they want to see that the organization is posting their own audited financial statements to their website. So those are some things that they're going to go out and check and score you on. And then they're going to look at a few compensation items. So they want to see that the CEO is listed on your 990 with their salary. And we'll talk a little bit in a couple slides about compensation and everything around that, but that is a requirement. So they want to see that. And they want to see that you're describing the process for determining your CEO's salary. So are you having a compensation study? Are you looking at similar organizations? What are you doing to make sure that that's reasonable? And they do not want to see board members that are compensated simply for being on the board. That is okay to do. That is just a negative indicator for this purpose. And as I stated earlier, so we went through the first area that they're doing regardless, but there are 3 other areas, impact and measurement, culture and community, and leadership and adaptability, that, you know, if your charity wanted to make sure that you're doing all you can to get a good public image on these types of websites, you can go out and self-report these areas. And I think they're primarily surveys that Charity Navigator will have you complete to be able to be scored. They will also provide some additional information that is not weighted in your overall score that they'll give you. So they'll provide the prior 3 years revenues and expenses, and they'll present that in a bar graph format. So they'll be able to see any trends pretty easily. And they'll also separately list salaries of key persons. So it's going to list the top 5 highest paid individuals separately. So, you know, instead of digging through the form and knowing where to look, it makes it much easier for the public to easily be able to see that information. So something to keep in mind. As far as key takeaways, so I think that there are some very easy items that maybe not all organizations are doing, but would be very simple to start doing simply to boost your score. So make sure that you have the 3 policies that they're asking about. And now it's very easy to find that online or use some other service to get those policies. And we also have some templates available if needed, so you can reach out about that. But also post your 990 on your website. As we talked about, it's available on multiple different sources, so donors can get it regardless, but putting it on your website just makes it, you know, more transparent for them, but also you'll get the points. So, all right, so the second polling question is, the 990 is open to public inspection for what types of nonprofits? So private foundations only, 501c3 organizations only, or all tax exempt organizations. Give a couple more seconds to get your answer in for that. And the answer is that the 990 is open to public inspections for all tax exempt organizations, not just 501c3s. I wanted to spend a few minutes talking about the tax bill's impact on donor development. So their One Big Beautiful Bill Act was passed over the summer, and it had some key changes that I think is important for nonprofits to be aware of as they are going out and fundraising. So beginning in 2026, taxpayers who claim the standard deduction may also claim an above the line deduction for cash contributions up to, and I have the thresholds there, so single filers are $1,000 and married filing joint is $2,000. So they did do something similar to this maybe in 2021 or so, but it was a much lower amount, I think $200 and $250, something like that. But a lot of people did take advantage of it. So with the higher itemized deduction thresholds, many people do not itemize. So this is definitely favorable for organizations to be able to advertise and make sure that potential donors are aware that they can get a deduction even if they haven't in the past. And just to note, this does not apply to donor advised fund or DAF giving. Some negative items, beginning in 2026, the tax benefit of charitable contributions is capped at 35%. So for your very high income filers in the 37% bracket, you're talking, I forget exactly what the threshold is, maybe 600,000 plus of income each year, they could get this 2% trim on the benefit that they're able to receive starting in 2026. So if you have donors that may be in the situation, consider having discussions with them about increasing their 2025 contributions to cover what they planned on giving in 2026 to take advantage of their full tax rate. Again, on the negative side for itemizers, so they added 0.5% of your AGI floor to the deduction. So say that threshold for you is $1,000 and you gave $5,000 of charitable contributions during the year, only $4,000 of that will be deductible for you as an itemized deduction. So with that in mind, itemizers should consider strategies that will maximize their deductions. A common example is to make larger gifts with less frequency. So maybe take an every other year approach where you're lumping your gifts. So you're only being subject to that for 1 year and not 2 years. So that's one option to maximize deductions there. So I wanted to talk a little bit about compensation reporting, since this is a particularly sensitive area, since it is open to public inspection. So first, whose compensation is listed? Officers are required to be listed, and that is defined as your top management official and your top financial official. So if you have a CEO, a CEO and a CFO, both of those individuals should be listed as officers with their compensation. You see CEO normally, but sometimes the CFO is missed. And you may have smaller organizations that those two officials are the same person, and that's okay too. They want voting members of the board should be listed with any compensation they receive. The next category are key employees, and there are 3 tests to determine who is a key employee. They're going to look at your wages threshold, which is 150,000. There's a responsibilities test, and then there's a top 20 test. So if you have anyone over that threshold, you'll want to look at those 2 other areas to see if they would be considered a key employee for reporting. And then finally, they have you list the 5 highest compensated employees, and this is the top 5 employees earning over $100,000, regardless of responsibilities. They're required to be listed with their compensation. An area that I see missed sometimes is that independent contractors over $100,000 are required to be listed in a schedule below the board listing. And I think that the reason is that people see independent contractor and they assume it's defined the same way as who you would issue a 1099 to. So they'll look at the 1099s and say, okay, no one over 100,000, we're done. But it's not the same definition for this purpose. So for this purpose, it's an individual or organization that receives compensation for providing services to the organization, but it's not treated as an employee. Some very common examples of this are professional fundraisers, law firms, accounting firms, publishing or other marketing companies, management companies is a big one, and then investment management companies. So if you have any of these vendors over that threshold, you'll want to consider if they should be listed here. And it's important to note that there is a carve out for insurance providers and public utilities. Those do not qualify for this reporting. So if you are worried about donor reaction based on the compensation that you have to report, I would encourage you to make sure you are providing appropriate explanations in this section of the 990 where they are asking you how you're determining compensation for these people. But if there's other information that you think would be helpful to donors to know, include that here as well, so that you're just providing the full picture related to those items. And I just wanted to spend a couple minutes talking about unrelated business income. So there are 3 requirements for something to be considered unrelated business income, which would be subject to unrelated business income tax for nonprofits. So the 3 requirements are that it is income from a trade or business, that it is regularly carried on, and that it is not substantially related to the organization's exempt purpose. So it has to fit all 3 of these requirements in order for it to be considered UBI. So as you're going through and determining if something is or isn't, it's important to make sure that it's checking all 3 of these boxes before you go down that path. I wanted to talk a little bit about some common exceptions and exclusions because I think these are missed sometimes. So some common ones that are available to nonprofits is volunteer labor. So if the majority of the work was performed with volunteer labor, maybe you have a nonprofit school that has a group of parents who put on a fundraiser. Well, that's volunteer labor. So anything that you do there is, even if it fits all the requirements on the previous slide, is not considered UBI because it was performed by volunteers. If something is provided for the convenience of members, think of a school cafeteria, that is specifically excluded, even though that would certainly meet all the requirements on the previous slide. Selling donated merchandise. So some nonprofits will have thrift shops either all the time or they'll do semi-annual sales or something. So as long as the stuff that they're selling was donated, that is specifically excluded from the definition. Bingos are excluded, so you wouldn't have to consider that. And then debt financed real property, so real estate rentals. Generally, if that is mortgaged or there is a loan on the property that you're renting out, that normally would be considered UBI, but there is a special exception that if the space is substantially related to the organization's exempt purpose, and that threshold is set at 85%, then you would not be subject to it. So a common example that I see are, say you have a nonprofit school that has facilities, you know, their gym, their soccer field, other places like that that they may rent out to the public periodically, that would likely fit this exception, even if the property is mortgaged, because you're meeting that threshold. And that 85% is a combination of time and space analysis that you can perform. And there's, you know, some objectivity there. Any questions?
We do not have any questions at this time.
Okay. All right. Thanks, Ashley. So we'll jump into the next section. So we're going to talk a little bit about internal controls. This section could probably be a 4-hour webinar in of itself if you wanted to dive in real far, but I tried to whittle it down to just some high-level things, some things to think about, some areas that might be some challenges, and just give you some things to think about as you look at your internal controls. So kind of at a basic level, what are internal controls? So you can think of them as, you know, processes, procedures, policies, maybe checks and balances or review and approvals. I kind of like to look at it, you know, how are cash receipts, cash disbursements being processed? You know, who's involved? You know, what sign-offs are required? Those kinds of things are what we mean when we're looking at internal controls. So really, you just want to ensure the reliability of your financial reporting is kind of the goal with these. So if you can have these processes and procedures in place and have a good system that helps ensure that reliability, because really at the end of the day you're trying to prevent and detect any fraud that may be going on, because you don't want your nonprofit in the news related to any of that. So so that's kind of a very basic definition of what we're looking at when we're talking about internal controls. So why do they matter? Number one, if you're getting donor funds, you want to be able to say you're a good steward of those donor funds. So if you have no procedures in place and that just kind of means anything could be happening with those funds, that would be a negative indicator for your organization. Public trust and public scrutiny. Again, you don't want to be the one in the news where something is being taken or misused, or somebody's complaining about how you're using those funds, or you don't have good again stewardship of those funds. You want to be able to show the public that you are taking care of what's being given to you, using it for your mission, and trying to further that goal. They could be related to compliance. So if you're getting a grant, or you have, particularly with federal funding, there could be things that you need to be doing from a compliance standpoint to be able to A, be eligible for those funds in the future, or B, even be able to keep those funds. You need to think about those kinds of things. So you could have a grant that might require you to have funds put in a separate bank account. Well, if you don't know that and you don't have controls over that and have a process in place for that, you could be out of compliance with a grant, which could lead to either negative feedback in the public, or just you don't have the ability to get that funding in the future, and maybe it's critical to your mission that you get that funding. The other item that I think it also gives some importance to internal controls is just protection. I think protection for your employees. If there's a policy and procedure in place and they're following it, you can't have somebody from the outside come in and maybe accuse them of doing something wrong, or if maybe something happened, you do get that protection to say, well, these are our policies and procedures, we thought about this, this person did do what they were supposed to do. So it does give them some level of protection as well. So what are some common challenges and maybe pitfalls that hit with internal controls? Number one, a limited staff, especially at smaller organizations. Maybe you only have one person in your accounting department, so you have that over-reliance on one person. Sometimes there's nothing you can do about that, but we'll get to a slide in a little bit to maybe have some ideas around that. But that can lead to some challenges about how do you get more people involved? How do you have somebody reviewing what only one person is able to be doing? Particularly post-COVID, you have that kind of in-person versus remote challenge. So, prior to COVID, most people were probably in the office. So if you had one of your controls was somebody needed to sign off on an invoice before it could get paid, well, that person was in the office every day. That made it pretty easy to get done. Post-COVID, maybe now it's more of a hybrid schedule, or people are fully remote. So now it's a little harder to get that physical signature on something. You gotta think a little bit about, okay, how do we pivot? How can we make this approval still happen, even if that person isn't physically in the office to sign something? Turnover can present some challenges. So, maybe you're plugging away and you have good policies and procedures, and then someone ups and leaves. So it takes time to find somebody to A, fill that role, and B, another issue that could happen with turnover, if you don't have written, documented policies and procedures, and that person just was here for 20 years and knew what needed to happen, if that person ups and leaves, how do you replace what they're doing if you don't even know what they were doing? So having some documented controls and procedures is another positive that why you should have these controls documented, and you can hit that turnover. Or maybe someone's out on a medical leave too, then you got to replace what they were doing. So having some backup and some cross training, there's all kinds of things you need to think about when you're looking at turnover. Going back to the grant situation, they could have some complexity, and if you're not aware of those, that can create a challenge to make sure that you have those things being thought about. And then resource constraints are another issue for nonprofits, particularly with controls. Maybe you do really want to have a 3-person accounting department, but your budget can't support that right now, so you don't have the resources to be able to do that. Or there's some different softwares out there that maybe you can take advantage of, donor databases that would help make things a little more efficient or streamlined. But again, those come with a cost, and there's that resource constraint that maybe it's not in the budget, or you're still being cognizant of that program service versus management in general expenses, just thinking through those types of things. So what should you consider when you're looking at internal controls? So in the accounting world, there's like a whole framework related to internal controls that is very, very lengthy. I tried to just pull down what are some main things to think about when you're looking at your internal controls. So Environment is one of the top ones. So really that tone at the top, you know, do you have the leadership of your organization buying into this and saying, yes, these are important things, and they're following through on their end. The last thing you want is to say, hey, we have these policies and procedures, and you know the executive director doesn't follow any of them. So you want to make sure that person, that leadership, or even the leadership group, if you have multiple people in that that realm, are and stressing the importance of these and following through on their side and being accountable to the policies and procedures. Risk assessment's another area. So maybe, you know, sitting down and looking at your organization and where are there some areas that maybe there's some risk or there's not a lot of people involved, or, you know, forward thinking, hey, we want to grow. What do we need to do to be able to do that? And what risks would come around that? You know, we're all humans and there's human involvement in these controls. So you got to think about that a little bit when you're looking at your processes and procedures. You know, where could there be something going wrong, and what could we do to maybe mitigate that, or how do we get more people involved? The activities in your control. So looking at, you know, approvals and reconciliations and documentation, you know, who's doing that? How is it being done? You know, we stress on the audit side of things with our staff in particular, if they're doing an audit procedure, that, you know, if they're saying they looked at an invoice to vouch something, but they don't document that they did it, well, how do I know that they did it? So similar for controls, if you don't document it, you probably didn't do it. We're big on documentation, and you can get a little creative with that. It doesn't always have to be a physical signature. You know, there's some electronic things that can happen now, you know, emails, but how are you documenting that review and approval is key as well, because it then again goes back to that protection, that you have a paper trail of what you did, how it was done, who was doing it, and that it was occurring. So documentation, I think, is a big key. Communication, as we said previously, you know, you got to have clear policies, and they really should be written. You can't expect people to know what they're supposed to do if they aren't told what they're supposed to do. So having a clear written policy and procedures manual is key. And, you know, again, as we said, some of that turnover, if somebody ups and leaves and, you know, they were doing something for 20 plus years, and now you got to find somebody to do that, but you don't really know what they were doing or where, you know, where's the check stock located, even simple things like that. Having that written is key. And we always, even the, you know, the Mack truck theory, if someone gets hit by a bus and you need to replace that person, if there's no written policy of what they were doing and their procedures, that's going to be hard to replicate. And it could lead to some, you know, pitfalls or breakdowns in your controls, which could lead to, you know, an error happening or fraud even in that case. And then monitoring is kind of another area to look at for your internal control. So kind of taking the pulse on your organization, you know, maybe sitting down and looking at it to say, okay, what are we doing? And then are we doing it? So maybe even doing a little bit of a review or a self audit. So, you know, maybe you say, hey, once a quarter, we're going to pull 5 invoices and make sure that, you know, they have the appropriate sign-offs, and the check signers were the, you know, if we needed 2 check signers on this because it was over a certain threshold, we do see that we had that happen. And if you didn't, then you can look at why did that not happen? Was there a breakdown in communication somewhere? Was it just not a clear policy? You can kind of see where there might be some holes and where there could be some risk that could be happening. So I think monitoring, doing a little bit of a pulse of your organization and seeing where you stand and where you think you stand can be a good tool to look at. And that can be for any organization, you know, from one that has 2 people in the accounting department to one that has 15. Again, we're all humans, things can happen. So if you are trying to stay on top of it and look at it in real time, it's a little easier to fix than going back, you know, something blows up and you realize, oh, well, maybe if we'd been doing this, you know, once a quarter, we would have caught it earlier and it wouldn't have turned into such a big ordeal that, you know, now we're in the news for, you know, something that was just a mistake. All right, so we'll do a quick polling question. So there's no right answer here. This is just kind of to take the pulse and see what the group thinks of what type of fraud do you think poses one of the greatest risks to your entity. So you could have credit card misuse, so somebody using the company card for a personal expense, a fake vendor, maybe, you know, somebody submitting an invoice for not a real vendor, an ACH scam, so getting an electronic payment to be misdirected, we'll say, a payroll fraud, maybe, you know, paying a ghost employee of some kind, or a donation or fundraising fraud where you're just maybe not using it appropriately or not even having it stolen right off the bat. So we'll give you a couple seconds to think about what you think might be the greatest risk to your entity. Okay, so a pretty even split across the board. ACH scam kind of leading the charge at 25% and credit card misuse right behind it. And I think that probably tracks with the environment that we're in right now. And we'll get to that. We have a little bit of a couple sections on ACH and just kind of the digital world we're in. So Ken, that works. All right, so segregation of duties. It's probably a big hot topic word you hear a lot when you think of internal controls. So really what that means is, no one person should control all aspects of a transaction. So you want to try to, as it says, segregate duties of the different types of transactions that you might have. So from a cash receipt standpoint, and this is very basic, you could have a lot more steps in the process, but you don't want one person opening the mail, taking that check to the bank, recording it in the GL, and then doing the bank reconciliation. They're getting their hands on in the entire process of that transaction. So if somebody, were to be stealing a check, there's nobody involved to really catch that could be happening because they're doing everything from start to finish with that transaction. Similar to cash disbursements, getting the invoices and approving them, writing or signing the checks, again, recording in the GL and doing that bank reconciliation. Again, nobody is in there having a second set of eyes on that transaction. That person is just taking it from start to finish. And then payroll as well, so, inputting employee data, so rates and addresses and bank account information in whatever, platform you're using for your payroll. Inputting your biweekly payroll data, if that's what you're doing. Monthly, you could, biweekly could be interchanged with however frequent you're doing payroll. So putting in all those hours and rates, and then processing it, recording it in the GL, and doing like a bank reconciliation. So again, that person is controlling the entire process. There's nobody else looking at that to catch if they're, putting a fake employee in or padding their payroll a little bit with some extra funds to get some more money directed to their bank account. So you don't want any person controlling all aspects of a transaction. And again, I know that can be a challenge when you have some smaller organizations or maybe one or two people involved. So you kind of just have to get a little creative, try to really find a way to separate that. So we kind of talked about this when we got through those items. So what could go wrong? Just some examples: the ghost employee. As I said, you could have somebody put in a fake employee and have them being paid, and that bank account's tied to their an account in their name. So they're just getting extra funds. It's not showing up on their name, so you maybe won't see it that way, but it's an employee that doesn't exist that's getting paid. Fictitious vendors, again, submitting a fake invoice, getting it paid, that check going to either their account or their address or an address that they can control. Again, that misuse of grant or donor funds is probably a big, and even that's not necessarily just fraud. That could be just an error, a mistake. If you don't have enough people involved or somebody that knows enough about that grant, they could be misusing those funds. And that could be a negative to how you're going to get those funds going forward. And then, the classical skimming or taking of funds. So you get a check in and it's for, this fundraising event. So we apply, 75% of it to that person's invoice, and we take the other 25%. And the next one that comes in covers, those kinds of things. You could get into that scheme as well. So what are some strategies for if you have limited resources or you have some turnover and you're just trying to get through with the limited resource in the moment? So if you can really try to separate some of that data entry from review, you at least get two sets of eyes on something that can help. So if one person's maybe putting it in the GL and then somebody else is at least doing the bank reconciliation or reviewing that bank reconciliation, maybe they'll be able to at least see, hey, this vendor looks a little funnier. If they do it for a few months and they see the same vendor being paid on the 15th of every month, maybe they'll think, okay, maybe I need to look at this, or at least ask a question about it. And sometimes even just knowing that somebody else is going to be looking at something might be enough to deter that person from trying to even commit the fraud in the first place. So if you can at least try to separate some of that gets you at least a little bit ahead of where you were with one person doing the entire process. Another item that I see is trying to involve some of your board members. And I know, board members are volunteers and they're volunteering their time as it is, and you don't want to, make them almost be like a full-time employee, but if there's a way to get them involved in part of the process, again, I think that can help. So it's important to consider that if that's your situation when you're looking at selecting board members, maybe trying to make sure you have somebody that A, has the time to do that, willing to do it, and B, has some maybe background in that, or has seen some of that before, has a little bit of a financial background maybe even as well. A dual approval on things, so maybe there is only one person able to do the whole transaction, but if you can get a board member to kind of be a second set of eyes on approving that invoice, that helps. I've seen that a lot, even thresholds, so maybe anything over $10,000 requires 2 people to approve it. So maybe the executive director, if that's the only person that's doing everything, can be the first approval, and then it goes to board treasurer or board president to also approve before it gets paid. Again, you don't have to necessarily have that person coming into the office and signing, yes, I approve that. You can do it digitally, whether it's an email or an electronic signature on that invoice. As long as there's some sort of paper trail where you can say, yes, this person saw this invoice and then it said, yes, it's okay to pay, that can help. Again, reviewing bank statements, your bank reconciliations, maybe that's a way to get a board member involved so that they can at least be seeing that and having access to it. Again, just maybe identifying some trends or seeing different transactions coming through, they may pick up on that and at least be able to ask a question. Checklist approval at each board meeting. I've seen that in a lot of cases as well, where you say, okay, for the last month we paid these 20 checks and they're listed in detail for the board to see. At least they're getting a set of eyes on it. And I know it might be after the fact, but you can try to catch again something there, or see a trend that the board's at least seeing what's going out the door. And again, if that's just in the back of somebody's mind that they know somebody else is looking at this and it's going to be being looked at, they may think twice before they try to submit a fictitious invoice. And another strategy I've seen, and it doesn't necessarily have to be a bill.com, but that's an example of maybe a way to get some approvals a little more easy for a board member. So it's a platform where you can upload invoices, and then there's a step of electronic approvals that can happen. So maybe that's a way you can easily check off, A, documenting that things are being approved, and B, having a board member be able to do it easily from their own computer where they can log in and look at that. So just some things to think about as you're looking at who all is involved and maybe even a turnover strategy as well to fill some holes in an interim basis. So a couple examples of some nonprofits that are in the news for some fraudulent activity. So this is one, and a couple of these are a little old. I think sometimes you get nonprofits maybe don't pursue these frauds because they don't want to have it be in the news, so it's a little harder to find some of these, but these are a couple of examples where there was some fraud going on. So this was from 2005 to 2012, so a pretty lengthy period of time. The director of facilities at this Woodruff Art Center, and I think this was in Georgia, if I remember correctly, stole more than $1.1 million. So part of it was kickback. So he had a maintenance vendor inflating invoices 30% to say, hey, we'll keep using you, but you got to inflate these invoices. And then that 30% went back to him. So again, maybe if somebody's looking at these invoices, they could at least see, hey, why did our cost for this go up year over year? Or seeing that trend of, especially the first time it happened, or maybe even the second time, to say, okay, maybe that was a one-off the first time. Why is it continuing to stay at this level? Are we actually getting 30% more work done or not? The other item that he did was submitting bogus invoices, so a fictitious vendor for expenses to be paid, including to one that was maybe not a fictitious vendor, it was a legitimate business, but it was a business owned by his wife. So again, that might be a little harder to track down, but you can see if it was a new vendor, maybe there's a policy or procedure in place when you get new vendors that they have to go through some sort of approval process or be vetted. So if that was part of their controls, maybe they would have caught some of this. The other item that allowed him to do some of this was he had the authority to approve contracts up to a $50,000 threshold. So there wasn't a second approval required, and not necessarily saying there needs to be on everything, but again, if somebody's looking at all these payments coming out and seeing, okay, we have a bunch of new contracts for $49,000, maybe somebody's questioning, or exactly $50,000 every time, maybe there's some questions there. So if there were more people involved or better oversight, maybe that would have gotten caught. Another one, the Jewish Federation of Fort Worth, so down in Texas. This was for 5 years, from 2013 to 2018. The controller wrote 326 fraudulent checks and almost $1 million taken again across 5 years. So in this situation, she was one of only 4 people in the office. So looking at a little more smaller organization, smaller people involved. So maybe they weren't having great segregation of duties. So she was able to kind of control things from start to finish and not have, you know, a second set of eyes on things. She was able to use a signature stamp, so that helps to be able to divert that. Okay, maybe their part of their policy was 2 people need to sign this check, but if they were signature stamps and she had access to them and nobody was really monitoring that, that's pretty easy to go ahead and just stamp a signature on a check that was fake invoice. In some cases, she was forging the signatures, and there's not much you can do about that sometimes, but I think just thinking through, okay, what could people be doing, and maybe how do we prevent that, or how could we catch that? You sit down and think about going back to that risk assessment. In this situation, okay, we have a small group of people. How can we try to look at, are there any ways that we can improve our policies to make sure something like this couldn't happen? Would be an example there. So, all right, so we'll pivot quickly in the last couple minutes here. You know, obviously we're living in a more digital world, especially post-COVID. I think COVID kind of forced our hand a little bit in this, but you're probably not maybe paying invoices with cash and checks a lot anymore. You're using credit cards to either, you know, get receipts from customers or vendors. Maybe you have the ability to, you know, your event you're having, you can pay online to have that. So you're not getting a check in the mail from somebody anymore. And you're paying things on a credit card regularly. ACHs, as we said, and as you all pointed out in your polling question, that's an area where you think there's some risk. So again, whether that's an ACH coming in or an ACH going out. And then you saw, you know, Venmo and PayPal are starting to be popular methods of getting payments and having people donate or pay for invoices or whatever. So definitely a more digital world and a less paper world that we're living in now. All right, so polling question 4, assuming you have ACHs or wire transfers as an option, are you requiring any kind of dual authorization? So somebody can go in and initiate, but then somebody has to go in and approve that ACH or wire transfer as well. So yes, all the time, every transaction, maybe it's only over a certain threshold. So anything over 100,000 requires kind of a dual approval. No, and that any amount of a wire can be done and initiated by one person alone, or you're not sure. So I'll give you a couple seconds to think about that. Okay, so always, all right, that's surprising. That's good to know. I think that's a good policy to have in place. So that's kind of the overwhelming majority. All right. All right, so maybe some strategies for credit cards if you're using those to pay for invoices or services a lot. So transaction limits. So maybe it's only, you know, transactions up to a certain threshold can be put on a credit card, and then you need to have a check instead. Vendor blocks are another method I've seen where maybe a merchant code, you can't swipe the card through that. That can be a little tricky. You might have to work with your bank on that, but I have seen that in some cases. Limit on card holders. So maybe not everybody in the office needs one. Maybe you only need to have 3 people in the office with a credit card, so you can kind of tighten who has the ability to be even accidentally swiping that credit card for something personal or doing it intentionally. Making sure there's no cash advances on those credit cards where somebody could, an employee has it and they can go get cash out of the bank on the credit card. If you can limit that, that will help limit your potential for fraud. Requiring receipts for all transactions. Again, I think this, just from a documentation standpoint, you have the ability to prove this transaction was for a legitimate business purpose, and here's the invoice that supports that. Now, I know sometimes maybe they're getting gas and the receipt, it's out of receipt tape. That happens, but having some sort of policy then in place for you can say, hey, maybe they just need to send an email and say, hey, I got gas here and the receipt won't print. So just so there's at least a paper trail if you tried to do something. And then I think review and approval of the credit card statements, including the executive director, is important. Somebody should be looking at those transactions on a monthly basis, making sure there's receipts. A lot of times the executive director is doing that for all the employees, but then there's nobody looking at the executive director's credit cards. So again, that's probably an area where maybe a board member might need to get involved, and they're looking at the executive director's credit card statement each month just to make sure that it's legitimate. And again, just knowing that somebody's looking at that credit card statement and looking for a receipt to prove that this is a legitimate purpose and a legitimate organization transaction might be enough to deter somebody from doing that. So ACH, these risks that come with these transactions. So what are the risks related to that? So you, again, unauthorized transactions. So somebody getting into your account and pulling money out that was for a transaction that's not even legitimate. A lot of times that can happen through a phishing scam. Maybe you get an email that looks like it's from a legitimate vendor. You go in to pay it, and then it's, you know, paid to the wrong bank account. It goes somewhere else. It gets diverted. An account takeover. So similar, you know, your email might get hacked, or your whole email could get taken over, or even your bank account could get taken over. And then you think you're communicating with somebody that you're actually not communicating with that person. And the issue with the ACH is it's simple and it's quick. You know, it's in and out of that account pretty darn quick. It's, you know, probably a day, and until you maybe realize it, it might be too late. So that's really the main risk with some of these ACH things, is how quickly that money can be taken and be gone. So just the last section here, what are some strategies around that? If you're really relying on ACHs a lot, maybe talk to your insurance company and what kind of cyber policies do you have in place should you ever have some sort of phishing scam or an email takeover or something to that effect that maybe could be covered by that. I won't steal too much from Seth's presentation or anything, but dual authentication or multi-factor authentication for any bank account transactions will potentially help if your log into your bank account gets hacked, but it needs to get a text message to a phone. Well, if that fraudster doesn't have your phone to get that message, then you should be hopefully in good shape. And this kind of goes back to that polling question, trying to separate an initiation and approval. And it sounds like a lot of you are doing that already, but looking at trying to limit how that can happen, that maybe two people are involved in that process, so that if the initiation is, a fake payment, hopefully that approval person can question it or say, hey, why are we making this payment? And even you can limit that for thresholds too. You won't have to do it necessarily for every single transaction. And then the other item is kind of talk to your bank about some programs that they might have. So the two that kind of pop out, positive pay, and then there's a reverse positive pay. So positive pay is, giving the bank a list of transactions or approved vendors, and then they match up to make sure they're on that list so that you don't have to. So that's one option. And then reverse positive pay, a little more cumbersome for you. It's better if you have lower volumes of these transactions, but essentially the bank sends you a list, say, hey, these are the payments that were submitted to us. Are there any that we shouldn't make? And you go through the list to approve it before it actually leaves your bank account. So a little different, but it might be worth pursuing that with your bank to say, hey, what are our options out there? So all I got.
I'm not seeing any questions related to internal controls, so I think we are ready to move into our 10-minute break. We're about halfway through. So it is about 9:55 right now. So we are going to take a quick break and come back right at 10:05.
Morning, everyone. My name is Brian Marchuk. I'm the Director of Outsourced Accounting with Brown Plus. Today, I'm going to be discussing nonprofit budgeting. First off, I understand that budgeting isn't a session people usually get excited about, and I get that. But I promise you, by the end of this, I hope you feel much more confident and comfortable with the entire nonprofit budgeting process. So before we begin, we'll just have a little introduction here of what our goals will be. We're just gonna really just build a nonprofit budget is what we're gonna be discussing today. You do not need to be a numbers person to follow along either. So today what we're gonna do is break it down step by step and make it simple, clear, and doable for really anybody. I would like you to think of practical, real world examples while this discussion is going on. I would like to consider this more a conversation than a lecture as well. So keep your organizations in mind as we go through this, and if you have any questions, please let me know. The first part we will get into will be the purpose of nonprofit budgeting. And what I mean here is not a textbook answer here, but most nonprofits really just treat this as a requirement, the budget, but the real purpose is it gives your organization a map. It's a GPS for your entire year. It's you saying, here's our mission, here's what it takes to accomplish our mission, and here's how we are going to get it with our dollars. Another purpose is transparency. Funders, they want to know that you're being thoughtful and responsible with the organization's resources. So when we talk about budgeting today, I want you to think of this not as a financial chore, but as a guiding system to help lead your organization with clarity and confidence. So with that, let's talk about the building blocks that go into a nonprofit budget. So we're going to break this down into 3 big sections here. The first section we have is going to be the revenue, which is the money coming in. Then we have expenses, the money going out. And then we have any special or one-time capital or special projects. So let's start with the revenue piece. Revenue is simply all of the ways money flows into your organizations, either by grants, donations, program service income, events, memberships, contracts, whatever source applies to your organization. Every nonprofit's mix is a little different. The key here is to understand what your mix looks like and how predictable each piece is. Next, you will categorize your expenses. Your expenses break down in the following buckets. We have program services, administrative and overhead, and fundraising expenses. Program expenses, these are things that are tied into directly delivering your mission. So they may be program supplies, program staff, materials, travel, and so on. Then our administrative costs, these are things that support your organization. So there are things such as rent, utilities, technology, insurance, leadership salaries. Then our fundraising costs, these support your development, such as donor software, marketing, printing, event expenses. Then the final item is the capital or special projects. These aren't part of your normal operations. These might be things like replacing equipment, major building renovations, or technology upgrades. They're important because they require special separate planning and funding. So now that we know the building blocks, let's dig into one of the toughest parts, and that's going to be revenue forecasting. Revenue forecasting is the part that makes a lot of nonprofit leaders nervous. Predicting revenue can feel a lot like predicting the weather with a blindfold on. So here the thing that most nonprofits need to do is you have your predictable revenue. So you can easily predict that. Then we have some unpredictable revenue, and then we have revenue that's basically a surprise every year. The goal isn't to be perfect. The goal is just informed estimation, and I will describe what that means. So let's walk through a practical approach. Step 1, what you want to do is pull the last 3 years of revenue and see what you notice. Are donations going up or down? Are fundraising events fluctuating wildly? Are grants stable or unpredictable? These past patterns won't give you all the answers, but they're your best starting point. Step 2, understanding the reliability of each revenue source. So as I said before, some sources of revenue are rock solid, like a contract that automatically renews annually. You may have a foundation grant that you've had for years. Then you have other moderately reliable items such as reoccurring donors, memberships, annual appeals. And then there are some that are a bit of a gamble, such as a special event, a new grant, or even first-time funders. When you build your revenue forecast, what you want to do is give more weight to those reliable sources and then be more conservative with the unpredictable ones. So if you have a gala that typically brings in $50,000 that it did on an annual basis, and then last year it dipped to $35,000, don't budget $60,000 for the upcoming year. that doesn't make sense. You want to be optimistic with your fundraising goals, but be conservative with your budgeting. Step 3 is understanding timing, and this is a big one. Nonprofits rarely receive money evenly through the year. Donations can bunch up at the end of the year. Grants might come in once a quarter. Some are even reimbursable grants, and they might take months. Step 4 is separating the restricted and unrestricted revenue. And if a grant can only be used for something like a specific program, and it cannot pay for things like rent, insurance, or leadership time, or fundraising needs, this should be treated as a restricted revenue and handled carefully. It is not a magic bucket either. Then finally, we have step number 5, build reasonable assumptions. Revenue forecasting does not need to be stressful. And once you've estimated your revenue, the next big piece then is planning your expenses. Expenses for nonprofits is where the real work happens. The expenses tell the story of what it takes to deliver your organization's mission. And when you plan expenses well, everything in your budget becomes much more accurate and much more useful, as we'll talk about. Let's start with the biggest category that most nonprofits have, that is personnel. If you're a typical mid to small size nonprofit, staffing probably makes up at least half, maybe even possibly 70 or 80% of your total budget. That is normal. It's not uncommon. You're a mission-driven organization that's powered by people in this case. Because personnel is such a large category, getting it right is extremely crucial. So this means budgeting for salaries, taxes, benefits, raises, stipends, any changes to staffing levels. If you're expecting new hires, shifting of roles, cost of living adjustments, or increases in health insurance premiums, you want to make sure you get that in the budget now and not after the year already begins. Then we have our program expenses. These are costs that are tied directly to your mission. These costs could include things like supplies, materials, transportation, workshops, events, contracted services, or other types of program-related expenses. It's helpful to ask your program staff what they actually need for the year. You'd be surprised how often especially your program staff have a much clearer of things they need. Leadership tends to just have the more high-level overview, and they don't work with the everyday as the program staff. Next is overhead or administrative expenses. Overhead gets a bad reputation, but let me reassure you, overhead is not the enemy here. It keeps your lights on, and that is literally, it keeps your lights on. These are costs like rent, utilities, insurance, bookkeeping, technology tools, leadership salaries, office supplies, and phone and internet service. Without these, your programs do not have a foundation to stand on. You also want to plan for fundraising expenses. Maybe you need donor management software, event expenses, design services, printing, digital ads, whatever the fundraising method that you use. You want to make sure you get all those costs into your budgets. And then we have our future planning related to costs. Costs almost never stay flat, so you want to make sure that you are proactive. Is your insurance premiums going up? Are you expecting technology upgrades? Are you adding new programs? Or is just generally everything becoming more expensive? Get ahead of these changes now so you don't end up mid-year scrambling. Once you've identified your expenses, the next big step is understanding how those expenses connect to each part of your mission. And that will bring us to our next area to discuss, and that is program budgeting. Program budgeting is where the budgeting process becomes eye-opening. It's the moment you can clearly see the financial story of your programs that your organization runs. In program budgeting, you take your expenses and assign them to specific programs that drive your organization's mission. This helps understand how much each program costs, not just the supplies or direct expenses, but the full cost of the program. So let's walk through steps of determining the full program cost. First, you want to identify your direct programming costs. These are things that go straight to the specific program, no allocation necessary. Next, you have your allocated or shared cost. And this is where people will get nervous related to the shared cost. And that's things like rent, leadership time, technology, subscriptions, utilities, insurance, anything that supports the organization as a whole. And you need to have a fair, consistent method to divide these across programs. Some nonprofits use things like staff time or square footage. That's what I typically see used. It doesn't matter which method you choose. You just want to make sure it makes sense and that it's applied consistently. Once you've allocated the shared costs, now you have the full cost of each program. Most nonprofits discover that a program that they thought was fully funded may need support when you look at it in this manner. Or you might see a program that you thought was financially healthier, or not as financially healthy, but is better than expected. Here's the thing, not every program needs to pay for itself. Some programs are mission critical, even if they do not break even financially. The goal isn't to cut out programs. The goal is to understand the true costs so then you can make meaningful and thoughtful decisions. Program budgeting also helps you communicate clearly with funders. When a funder sees the full cost of a program, they are more often willing to support the administrative or indirect costs because they understand the full picture. Next, let's talk about one of the most misunderstood topics in nonprofit budgeting, and that's the financial overhead. But first, let's go to a polling question. The question is, what is a typical large expense category in a small to medium non-for-profit organization? And the answer is personnel costs. Overhead, back to overhead. Overhead is not a bad thing. In fact, overhead is essential. It keeps your organizations standing upright. Overhead will include things that keep your organization running behind the scenes, like rent, utilities, insurance, administrative salaries, office supplies, bookkeeping, technology tools, and legal and compliance needs, just to name a few. These aren't extras either. Without overheads, your programs would collapse. Now, the tricky part is allocating overhead to programs. And this doesn't have to be complicated, and talked about two possible ways of allocating previously. Again, the method just needs to make sense and be used consistently. Some nonprofits, again, will assign overhead based on staff time, which is very common. There's others that might use square footage or some other method. There is no perfect method, and what matters, again, is it's logical, fair, and that you stick with it. So the takeaways here is simple. Overhead is necessary, it's healthy, and strategic. The more you are intentional about it, the stronger your organization becomes. Next, speaking about being intentional, let's move into one of the biggest reasons nonprofits fall apart during the year, and that is cash flow. Cash flow is often one of the topics that gets overlooked until it becomes a crisis. Even the most well-run nonprofits can struggle with cash flows if they're not paying attention to timing. Cash flow is the simple understanding of when money comes in and goes out. And those two things rarely line up neatly. Here's an example of a nonprofit that would receive a big chunk of donations at or around the year end. So the November-December timeframe are the biggest months. But the same organization has rent, utilities, and program costs throughout the year. So every single month may not have revenue under this circumstance. Possibly even grants could be a similar way. Maybe you're awarded $100,000. It may not arrive in one payment. It could arrive in two, quarterly. It could be a reimbursement where money has to be spent up front, and then you would request reimbursement of the money you spent later. Those timing differences do matter, and they matter a lot. And that's where a monthly cash flow projection would come in. This takes the annual budget and spreads it out month by month, so you can see if there are any tight spots. Maybe February and March look thin. Maybe the summer months are slow. Maybe you have a big surplus in December that will sustain you into the new year. Cash flow projections will help you avoid unexpected cash shortages, plan for reserves, and decide when to spend or delay expenses. They also assist with preparation for conversations with the board when things get tight as well. Now that we explored the major building blocks, let's talk about how to prepare for unexpected things through scenario planning. Scenario planning is one of the most important things you can add to your budgeting process. Scenario planning helps you get ahead of surprises instead of reacting to them in panic mode. If a funder would get a delay of payment, a grant does not get renewed, a donor gives more than expected, maybe a program expends faster than planned, scenario planning will help you handle that with what hope to be a calm and confident plan. The idea is simple here. Instead of building one budget, you're going to build three versions. The first scenario is going to be your base scenario. This is going to be your most realistic version. Then we have our scenario 2. This includes the optimistic scenario. This includes things such as opportunities that you may receive, such as new grants, your fundraising event beats expectations, or your donor commits to a large gift. Then we have our scenario 3. This would be our conservative scenario, possibly a lower fundraising event, a delayed reimbursement. Program costs are more than expected. By mapping these out, it gives your organizations options. You can say, if you get this grant, here's what we'll do. If we don't, then here's what we'll do. What does that mean? Now let's talk about board and stakeholder engagement next, because even the best budgets won't work if the people around it don't understand and do not support it. So let's start with the board's core responsibilities around the budget. So first thing they do, boards provide oversight. They also approve the budget, and then they monitor the financial results throughout the year. Let me just be clear of one thing: the board should not be creating the budget line by line, but I do understand that could happen depending on the size of your organization. Typically, the board's job is governance. It's not micromanagement. The board should understand the big picture. When revenue, they should understand things like where revenues come from, how much a program costs, what are the major risks that exist, whether the organization overall is financially stable. When you present budgets to a board, you want to make sure that it is clear, focused, and then tied it to your mission. You want to avoid drowning them in things like spreadsheets. Show them key assumptions, the major drivers, the overall financial story of the organization is what you want to get across. You want to get that, they should walk away with clarity and not confusion. Next, let us talk about your staff and donors and the other stakeholders that are involved. You want to involve people in the budgeting process. And the reason you want to do that is because it builds ownership and alignment. Staff, especially your program managers, usually have more practical insights to what their programs actually need. When you include them early, you get better information, fewer surprises. You do not need to send your staff the entire budget, but show them the high level information, the priorities, and then the strategic thinking behind it. What this does, it builds trust. Engagement overall is not about giving everyone control. It's about giving everyone clarity. So let's talk about how to use the budget throughout the year with budget versus actual reports. A budget versus actual report, and I'm going to call it a BVA for short. This is a practical tool that you'll use after the budget is approved. If your budget is a plan, I would consider the BVA a scorecard. This tells you what is going on and the way and what to expect, what may need attention. And just to be clear, when you have variances, this does not mean that something is wrong. Variances are totally normal. They're simply a sign of signals. Budget versus actual compares the budgeted numbers to what you actually plan and what really happens. So reviewing this regularly keeps your budget alive and useful. If your budget gets looked at only once or even twice a year, it's not a management tool, it's just a document at that point. So when we're looking at our BVA, these are the big questions we want to ask. First, where are the variances? If revenue is higher than expected, great, why? If revenues are higher than expected, why? Did something change? Did we forget something? Or did something important just cost more? Second, is it timing or is it reality? A lot of variances aren't actually problems, they're just timing differences. Maybe your event revenue comes in June instead of May. Maybe a grant payment arrives early. Maybe you bought all of your program supplies in the first month instead of spreading them out. Timing differences are normal and they're not a cause for panic. Next, third, is it a trend? If program supplies were high for 1 month, is there any special reason? But if they're high every month, then that's considered a trend. And that might mean you need to adjust your program or overall budgets to revisit your assumptions. Fourth, do we need a mid-year adjustment to the overall budget? Some nonprofits treat their budget as they're sacred and untouchable. However, budgets should evolve if reality changes. If a major grant falls through or a new partnership emerges, updating your budget isn't failure, it's just considered smart management. I like to think of the budget versus actual as your early warning system. So if something starts to drift, the budget versus actual will catch it before it becomes a crisis. The polling question, what is the primary benefit of reviewing the monthly budget to actual reports? And the answer is B. Back into the presentation. So let's talk about common budgeting mistakes that nonprofits make, because avoiding these will save you a ton of headaches. The first mistake is overestimating revenue. It is tempted to be hopeful, such as we'll definitely get that grant or that fundraiser will be our biggest ever. Although budgeting based on hope instead of history will get you into trouble fast. The second mistake is underestimating expenses. Costs rarely stay flat. Insurance goes up, rent goes up, supplies go up, software renewals go up. It all adds up. If you assume everything will cost the same as last year, you're just setting yourself up for a mid-year panic. Third mistake is forgetting about restricted funds. If a grant is restricted or a specific program, the money does not help to pay for general operating expenses. Treat restricted revenue carefully in your planning. And the second to last mistake is ignoring cash flows. A lot of nonprofits run into trouble because they may not have enough money for pieces of their fiscal year, but do for their overall. The final mistake is nonprofit cash not being received uniformly throughout the year. Again, cash may not be enough for specific times. Next, budget calendar. A budget calendar, this is an easy way to create an entire budget process for your teams to follow. Typical calendars range from 4 to 6 months. You want to make sure you get staff input and have the board review the drafts. This will prevent rushes and inaccurate decision making as well. Technology and tools. You do not need to use the most sophisticated tools. Excel and Google typically work the best. I would say if you start to grow out of that, there are other softwares that can be used as well to help with forecasting. So final thoughts here. The budget process is not meant to be as scary. You want to make sure that you get total buy-in from your organizations. You want to make sure that you get realistic information and inputs. You want to remember that what you're doing is important for the communities. It helps us and it impacts everyday people. So if there are any questions that come up as you go through your budget process, since you should be wrapping up on that now, please reach out to me and we can have discussions. So thank you very much and good luck.
All right, thanks, Brian. We don't have any questions about budgeting, so I'm gonna have you come up and we'll have Seth take over for data security.
Okay, well, good morning. I think I can still say good morning. It's still early enough for that. Appreciate you joining the cybersecurity and data protection for nonprofits. My name is Seth. I am the IT director at Brown Plus. And before we jump in, I did take a peek at the attendee list and notice we don't have any IT professionals joining us today, which is actually, I think it's a good thing. You know, years ago, this webinar would be probably more specific to IT professionals, but really in today's society, it's about cybersecurity and data protection awareness for all team members, because every team member plays a crucial role for keeping your organization safe. So I wanted to start off with this quote: "Trust is built in drops and lost in buckets." And I just think it's an appropriate quote for this presentation. It can take years to kind of build relationships, build trust, and really in a matter of seconds, we can lose that trust. So why does cybersecurity matter for nonprofits? Well, it matters for all industries, but specifically nonprofits. It matters because we know they're targeted at a higher rate than other industries. And it's for many different reasons, but one of the reasons is because limited budgets. And that can sometimes mean weaker defense systems. So I spent, before coming to Brown Plus, 13 years in nonprofit higher ed. I get limited budgets. I get the CFO moving into my office during budget season. And usually for the last 4 or 5 years I was there, it's like, hey, we need to cut another 10% of your operating expenses. And so how do you do that and still maintain that level of security that you need to keep your organization safe? So I get it. But also cyber criminals, they get that, they understand that. So that's why they're specifically targeting you. They're testing your system. Is it strong? Is it weak? Can I breach it? Another reason is you want to maintain trust, right? With your donors, your clients, with the community. And cyber criminals know you have data that they would love to get their hands on. They want that donor and client data. They want your financial information. So the current threat landscape. So ransomware, data breaches, so they're on the rise across all sectors. And looking at some of the data from 2018 to the end of 2024 last year, publicly reported data breaches more than doubled. And so this isn't just a spike that we're seeing in the data. This is more of a new baseline. So it's an upward trend. And we don't see it slowing down. It's going to continue to rise. It's going to continue to cause organizations problems and headaches. Right here in Central PA, it was last year where we had a nonprofit organization, not going to mention any names, but they were breached. 20 gigs worth of data was stolen by the cyber criminals. And after they stole the data, they encrypted a lot of the files that were on their network and also in their applications. And so really what that means when they encrypt files like that is they're password protecting the document. So you can't open it, you can't read it, you can't save it. It's basically unusable unless you have that password or that decryption key. And it's extremely damaging, those types of breaches, just not financially to your organization, but also to your reputation. I don't know the details of that specific breach, but what we do know is that phishing and social engineering attacks are the #1 entry points. And so what we're seeing is they're still trying to hack systems, but now it's more of, hey, can we hack people? Can we hack trust? They know if they compromise your account, they can use your internal account to compromise other accounts within your organization. And so, how are they doing this? So something that's interesting is years ago, they would just mass email tens of thousands of emails and hope to get a click. Well, now they're being a little bit more strategic. They're looking for nonprofits. They're finding your website. They're saying who's part of the leadership team, who's part of the finance team, the CFO, the controller, and then they're creating emails to look like it's coming from those individuals. And really what they're hoping is that you're clicking on a link or some other means to capture your password. So it can be a SharePoint document that you click. It takes you to what looks like a Microsoft website, but it's really the hackers. They have their own website stood up and that they're gaining access to your email address and your password. So they're doing this with emails, text messages. They're also doing it, maybe you've seen some of the deep fakes with AI out there. If you're on social media, I'm sure you've seen tons of videos by now. I mean, honestly, it's hard to tell what's true and fiction. The other day I watched a grizzly bear climb up a high dive and do a cannonball into the pool. And I kid you, I watched it like 20 times looking for that blip. I couldn't find it. It was so realistic looking, but they're using the same type of technology to capture voices. And so they're going to your website. They're looking for that promotional video. Maybe it's a social media site that you have where your executive director is giving a speech. They're capturing that voice. And then they're targeting your finance team. You're calling your CFO. They're calling that controller and saying, hey, we just received approval for a time-sensitive grant disbursement in the amount of $75,000. And I need you to wire that money to this account immediately. And it's working. It's working. It has very high success rates. So again, awareness for everyone that this is going on. And then third-party vendors with shared risks. So any third-party vendor that stores or processes your data, you should be asking them to provide you with reports and procedures that shows their security posture. Now, this might not mean much to you, but you should be asking for these documents and passing this off to your IT team. So they're vetting it and they're saying they're reputable and that we should be really storing our data in their systems. So top cyber risks. So we know phishing is #1 entry point, and that happens by human error and lack of awareness. Again, it's not a fancy hacking tool that they're using. They're trying to hack your employees. So what do? I always say 3 things: slow down, don't engage, and follow your internal procedures. There's always going to be some type of urgency. I need you to disperse these funds immediately, right? I need you to click on this link and approve this project right now. Slow down, okay? Don't engage, and then again, follow your internal procedures. Is it strange that even though it's your president calling you with their voice, that they're asking you to disperse this amount of money, wiring it right away? Maybe you don't wire money. That should be a huge red flag. Maybe there's a certain protocol that you go through before you wire that money. Again, follow your internal procedures. Personal or unapproved applications. So never store or send any of your organization information for personal or unapproved applications. So a great example would be a personal Dropbox account or a Google Drive account where you're saving data, or you're using your personal email to send documents. This should be a huge red flag. Nobody within your organization should be doing that. Outdated or unsupported software. Not to get real technical, but if you're a mid-size or a larger, you probably have a good mix of some data that could be on-prem and then some that you're storing in the cloud. If you have on-prem data, that requires a little bit more attention. So you have to have a team that's always patching that, keeping the applications up to date. But even if you're just all cloud hosted, you're using a device to get to that cloud hosted application. Who's patching it? Who's making sure the security updates are being applied? Again, this isn't for you to be doing, but you should know that it's being done. A great example, Windows, Microsoft just said Windows 10 is end of life this past October. So if your device has Windows 10 on it, I'd be calling your IT guys up or girls up and saying, hey, why are we still using Windows 10? It's end of life. You can pay to extend the support, but I would say that's a yellow flag and you should be aware of it. Security best practices. Okay, require MFA everywhere. And you're probably used to this by now, even on your personal financial applications you have, whether it's banking, whether it's retirement, that you're getting that notification to say, is this really you? A good rule of thumb would be if you're accessing any of your organization data remotely, whether you're at home, you're at a coffee shop, wherever it is, you're at the beach vacationing, you should absolutely every time be receiving some type of MFA notification to say, is this really you? If you're not, again, talk about it. Ask your IT department, why not? Using strong passwords. So the definition of a strong password has changed a lot over the years. So when I first started in IT, it was minimum of 8 characters, maximum of 15. And then they said minimum of 8, add some complexity in there. And kind of what's interesting, and I use Microsoft and I use NIST.gov, which is National Institute of Standards and Technology, to look at their best practices. I encourage you to go look. They're saying length over complexity. So I still encourage complexity, but they're saying minimum of 15 to 20 characters. So a minimum of 15 to 20. And I try to say, use a passphrase, something that's unique, something that you can remember. And I'll give you a goofy example. So maybe you like giraffes. Maybe you like to dance. So a great password would be giraffes dance at midnight. Again, throw some complexity, throw a special character. I guarantee you'll remember it after entering it 2-3 times, and that's a great, strong password. And then lastly, the role-based access with least privilege. So what we see happen frequently is, say you're evaluating a new software and you add all of your employees into the system, you give them full access because you're trying to, all the features, you want to see how everything is working, everyone has full access, then you go live and those permissions are never scaled back. And so really role-based means create groups, have one for your staff, have one for your volunteers, have one for your board members. And then I always say least access, start with the least access needed to carry out their roles and responsibilities. So that means that you might be calling IT or they might be calling you to say, hey, I can't do XYZ. And you might say, well, that's good, you shouldn't be able to. Or you might say, okay, you should have that access and you're bumping and giving that access out. But at least start with that least privileged access. All right, polling question. Which of the following poses the greatest cybersecurity risk to nonprofits today? Is it phishing and social engineering, weak passwords or lack of MFA, outdated systems or software, or vendor or third-party breaches? And it is phishing and social engineering. Data protection and privacy. Okay, I'm going to read through these and we're going to dig into them a little bit, but identifying confidential data, store data only in approved and secure systems, and then comply with privacy regulations. And really, you could sum all 3 bullet points up with one policy, which is a data security policy. Write that down. If you don't know what it is, I can guarantee you don't have one for your organization. So a data security policy is crucial for every organization because it identifies what confidential data is. If you ask one staff member, maybe they have a different idea as the other of what really confidential data is for your organization. If you're like us, you have to comply with the IRS. They tell you, hey, this is what PII data is, and this is how you have to handle it. It even carries over to paper copies. Do you need to secure paper copies in desk drawers if you're not in your office? All of that is governed by that data security policy. And then storing the data in approved and secure systems, I always like to say it needs to be organization owned and organization managed for you to be able to store data in that system. Backup and recovery. Okay, so we talked a little bit about maybe you have on-prem data, maybe it's all in the cloud, maybe you're a mix. A lot of the mid-size and larger have a mixed environment right now. If you have any on-prem data, this is specifically for you, but you need to have multiple backups. Okay, and why is that important? Well, most of the time your backups are taking place right where your equipment resides, so you can restore real fast, right? But in a true disaster, when your office is gone, fire, flood, or other means, you need another copy of that backup to restore from. And at least that copy, or maybe a third copy, should be what's called immutable. And it's spelled IMMUTABLE. If you have any on-prem data, write that word down, ask your IT department if you have immutable backup. And why is that important? So the example that I gave you of the local nonprofit that was compromised, one of the first things cyber criminals do is once they have access, once they breach your systems, they will take some data and they'll save it. Okay, so now they have copies of some of your data. The next thing most of the time that they're gonna do, they're gonna try to find your backups and destroy them. So now when they compromise your other data and they encrypt it and you can't use it, you're calling cybersecurity teams, they're coming in, they're kicking the bad guys out, they're patching the hole the way they got into your systems, and now they're gonna say, okay, let's restore your data. And if your data's gone, you can't restore it. With the immutable, you can't delete it, immutable backup, you can't change it, you can't do anything to it except for restore from it. And that's why that backup is so important, it really is. And then test restores regularly. You don't want to be in a situation where you need to have a restore done immediately and you're running into issues. Make sure you're testing this. And I've been part of tons of DR tests in the past, disaster recovery. The issue is not usually the backups, you're usually running into issues when you start your restores. So test it regularly. This is even if you have cloud hosted environment. Do you even know if you can restore your data? Should you be reaching out to your vendors and saying, hey, what happens if a file is deleted? Or what happens if some malicious attack occurs? How far back can we even go to restore some of that data? And then lastly, have a plan. And I'll say 2 plans that every organization should have is a disaster recovery plan and a business continuity plan. A disaster recovery is really focusing on your technology. Hey, what systems do we need to have up and in what order so that we can continue to service our customers? Okay, and then the business continuity is how do we maintain a level of business across all departments, and it's identifying, your human resources, it's identifying marketing, and every member plays an important role in that plan. If you're not sure, again, ask your IT department. If they don't have one, a great place to start is ask AI to help draft these 2 policies. And that just gives you a very high level understanding of maybe what goes into that plan. It might get you 30, 40% of the way there, but at least it gives you a starting point. Staff awareness and training. So for the next 3 bullet points, I'm gonna say you need to partner with a third-party vendor for these 3. Don't try to do this yourself. It does cost a little bit of money, but it's money well spent. Okay, so conduct annual cybersecurity training. So you should have cyber professionals that are either coming in or a lot of them done remotely, and they're going over, hey, these are the best practices you guys should be looking at. Hey, here's some new attacks that we're seeing. Here's how they're trying to trick you and your team members. Again, it's training, it's awareness. Every team member plays a crucial role in keeping your organization safe. It's penetration testing. And so basically what that is an ethical hacker that's outside of maybe your office that's trying to penetrate inside and seeing what they can compromise. And then they'll send you a device that you plug into your network at your office, and they try to do another compromise internally. And they give you a report, and maybe 15, 20-page report, and it's very high level. It's green, yellow, red. So here are the areas that you were green. Here are the areas you were yellow, meaning, hey, you might need a little bit of help. And then here are some red areas, and these are critical areas. You need to address these immediately, extremely high risk. I recommend every organization going through that every year. And then simulated phishing tests to build awareness. We just had the organization that we partner with maybe about 2 months ago. They sent a phishing email to every team member. They made it look like it was coming from a member of my team, one of our help desk agents. And it went to every team member. There's a link at the bottom that said, hey, click on this document. It looks like it's taking you to, again, Microsoft SharePoint document. Put your credentials on it and approve or look at this new policy. And that vendor that you're partnering with, he can come back and give you a detailed report. Here's who opened the email. Here's who opened the email and clicked the link, and here's who clicked the link and actually entered their credentials. And you can actually see their credentials. You can go to the employee and say, hey, I know what your password is, okay? And it wasn't Draft Dance at midnight. It was something that was easily compromised maybe too. So this is an education, okay? This is not to shame anybody, but it's really just to raise awareness. And then create clear reporting channels for suspicious activity. And so what do you and your team members do when you receive an email, when you receive a voice call that you think could be suspicious? Make sure that you have those channels clearly communicated to your team members. Do you just delete the email? Do you forward it to your help desk and then delete it? You should have clear channels that everyone knows what to do in case there's any type of suspicious activity. Okay, last polling question. Who is primarily responsible for protecting your organization's data? Is it the IT department or your IT managed service provider, leadership or management, every staff member and volunteer, or software providers? And the answer is, I repeated this so many times, I'm hoping everyone got it. It is every staff member and volunteer. So practical next steps. If this is what you take away, do a snippet, keep this. Enable MFA, require strong passwords, data security policy, verify backups can restore files, create a plan for incidents, and then train, and train again. Any questions?
I am not seeing any questions at this time, Seth.
Okay.
Okay, so that concludes our nonprofit webinar today. Thank you all so much again for joining us today for our webinar.